All right. Good afternoon, everybody, and welcome to the Exposing Your Annuity webinar that we put on. So we are broadcasting live from Brea, California, here in our friendly confines of our office building. So just to let you know of everything that's going on today, I want to introduce myself. My name is Jayce Lowe. I'm a wealth manager with Lighthouse Financial. I want to also let you know that I have Tevin. He is also moderating the chat log and anything else that's going on with this webinar. One more thing with the webinar is there's going to be about a 5 to 8 second delay. So I'm keeping that in mind whenever I'm clicking and going from slide to slide. So I'm trying not to go ahead of you. We also have some polls that'll show up that, would like some participation in some of the questions that I'm asking. And then we have some offers that'll show up some point in time. So just to kind of keep everybody privy to what is happening with this webinar. So just to let you know right now, we're going to go ahead and get started because I believe everybody is in that was registered for the webinar. So welcome and thank you so much for taking time out of your day to join us. So my name is Jayce Lowe. I'm a wealth manager with Lighthouse Financial. I have eight years of experience in the industry. I'm originally from Texas. I moved to California in 2017, and that's whenever I started with Lighthouse. So previously with Lighthouse, I was on the broker-dealer side. I was with the firm that sold everything that you could imagine. So I've seen uh, what what happens on that side. I've seen the process of what happens. I've been able to envelop and analyze everything that goes on with not only selling annuities but other products. So just kind of exposing annuities for what they are. Now, this isn't a webinar to bash annuities or to make everybody feel bad if they purchase an annuity. This is to educate individuals and families and everyone else what annuities are. So let's just get going. Kind of as we go through this process, a lot of people have asked me in the past, where's your Texas accent? And it comes out, it comes and goes. So I've learned a long time in this business. I have to enunciate what I'm saying, or it kind of comes out very twangy. So the accent will come out every now and then, but it doesn't because I really try to make myself sound clear. All right. So the goals for today. I want everyone to understand either their annuity that they have or possibly annuities that we're going in and out. Hold on, Jim. Let me go ahead. Can you hear me a little bit better? All right, let's kind of do. Let me pause for a second. Can people go over to the chat log? And can you hear me clearly right now? Does it sound a lot better? Hello, hello. 1, 2, 3, 4. All right, we'll just kind of take time out for a little bit. Does that sound a little bit better, Jim? Okay, good. All right, we may go for it. It may just be a little delay sometimes down the fine fiber optic wires that our friendly internet provider uses. Sometimes it can be a little bit congested, and especially right now at this time. 4 o'clock and 5 o'clock is pretty busy in the internet line. So it may have just been some connection issues at the current issues. You don't hear me? Oh no. Okay. Hold on 1 second. Let me turn my mic off and then turn it back on and see if that fixes it. Hold on 1 second. All right. Does that sound better? Is it clear? Everybody can understand. This is the first time this happened. We've done three of these in this past week. I'm sorry you're having to deal with this, Jim. I'm sorry everybody else. I apologize for the delay. Um, let's see. I wonder why. I'm going in and out. Yeah, we might have to. You might have to use the Google app. And Jim, I tell you what, if this is in and out like this, and you can't really hear me, this is being recorded. And what I'll do is send you a replay of what's going on with it, and you can watch it at your convenience. So um, that's kind of what we'll. Oh, okay. Internet Explorer. Yeah, sometimes Internet Explorer is a little bit of a foobar on that. So, all right, let me go ahead and get started. We'll record this for you and send you a replay so you can watch it and hopefully clear and concise and everything else. Um, so, okay. So the goals for today, I want everyone to understand their annuities. I want you to understand the types of annuities, the purpose of an annuity, and then really the 10-year evolution of annuities. So I'm going to help you walk through how annuities are built. So we're going to talk about what you're sold on. What you're sold on is volatility. We're going to talk about service that you receive from your sales rep. And then I kind of give it a variable annuity explanation. So I kind of go through the process of how I've been able to easily understand how annuities are built, how how your money is invested, where it comes from, and everything like that. Number three, I want you to understand your statements. Now, this webinar is not to help you fully on understand your statement because every statement is going to be different. I've looked at, I don't know how many different annuity company statements. They're all different, but I understand the lingo that they're using, and I'm able to kind of walk a client through exactly what they have. But this little webinar is not going to help you in terms truly understand your statement because I can't see it, and it's best if I can kind of see it and go through it with you. And then the last one is we not only do this with annuities, we do this with every investment or every other in question that clients have, but it's here to empower you to make an informed decision on what to do with your annuity specifically. So again, this is being recorded, so you will be able to hear a replay later on. I believe it's 24 hours after the annuity or after this webinar is over with. So let's just kind of give a brief description of who is Lighthouse. So Lighthouse Financial, we were founded in 1992 by George McDaniel, and George really wanted to be able to provide a honest, ongoing, fantastic company for clients to go into and deal with investments because all times more than not, we are sold by salesmen out there in the investing world. So what salesmen do and what companies do that are highly driven on sales is time and time again, they're out there working really, really hard to get clients money. So they'll put offers out there that are maybe they're cheaper, maybe they have this service, maybe they have that service. And whenever we envelop a lot of these and truly open them up, we find out a lot of these other companies are truly doing a lot of stuff on the back end that aren't right for the client. They're not doing their responsibility. That is what the client wants. And really, most of these companies are putting clients in cookie cutter financial strategies, which is not what anybody wants when they deal with a true financial advisor. They want somebody that's going to do a custom plan that knows their family, knows their situation, can really do a full-on view. So that's who Lighthouse is. So we handle financial planning, tax services, investment advisory services. We do it at the utmost full service capacity that we can for clients. And the fee only. Now, a lot of people hear fee only. Pardon me, I don't know why it skipped ahead. A lot of people talk about fee only. What is fee only? Well, you're going to see that term used a lot more often, and you're going to see a lot of companies use it because they realize that is a tag that a lot of clients go off of. But what is it to us? Fee only to us is we have no conflicts of interest. We have no biases when someone walks through our doors. Our clients and everyone can reaffirm everyone that when they walk through the door, we don't treat them like everybody else. Their financial situation is completely different than someone that walked in before or someone that will walk in a little later that'll talk to us about finances. We have absolutely no commissions. We don't sell mutual funds, and we don't sell any other product that generates a commission to advisors. To us, that is very, it's not honest, in our humble opinion, as far as what is provided to clients, because there's a lot of back end, there's a lot of hidden fees. We have no hidden fees on this. And there's just, we don't want any of the unfair dealing of our clients' money. So what do we sell our clients and our prospects and people that want to do business with us? Well, we sell our service. We we provide, and we want, our goal is to provide the best service that educates our clients and empowers them to make the most informed decisions in their financial goals today, tomorrow, and in the future. So that's really why George created the company in 1992. So it's really 27 years of providing really, really good service to clients. And that's what we continue to push. And we want to continue to push that even as the industry continues to move on. So let's talk about what types of annuities are out there. So the very first, the simplest annuity is the fixed annuity. Everyone is probably familiar with a fixed annuity is. If you're not, let's go ahead and go through it very quickly. Fixed annuity is very simple product that has a fixed rate attached to it. You can buy it for 1, 5, 10, however many years that you decide to get into it. So it's typically your original investment plus the interest on that annuity. So the way that I describe this fixed annuity is it's very similar to a CD. So what you put in the bank, it grows and grows and grows, and whenever the maturity is up, the bank gives you your principal plus the interest. That's how fixed annuity works. But fixed annuities, they can have death benefits attached to them. They're just a very, very simple annuity product. So you're just buying an interest rate, basically, that's typically higher than the Fed fund rate and even CD rates. All right, the next step up from that is the fixed indexed annuity. I don't really know exactly when the fixed indexed annuity was created, but it was created for this purpose. It was created to give a client the ability to track index, um, and then also to protect the downside of that annuity. So this individual person may be able to go into, as you know, I doubt some of these fixed annuities are capped, S&P 500 index. But here's the big differentiator between a fixed index annuity and, say, a variable annuity. A fixed index annuity will cap your gains, typically at 5 or 6%. So let's say the S&P 500 does, back in 2017 numbers, it was up 22%. You don't get 22%, you get 6. So what happens to the rest of that interest rate? Well, it's revenue to the company. The company gets to keep that revenue. So you as the client may feel a little miffed by that. But whenever you get into a fixed index annuity, they are capping the upside potential in that. Now, the reason why people get into fixed index annuities is you have the downside protection. So let's say if the market goes negative, 2008 goes down almost 45% or more, depending on your strategy, you get a zero for that year. You don't participate in the negative market, you just stay flat. So that's where it comes in. That's what you're buying. So you have the original investment with downside protection. You're capped on the index performance. Some of the things I've seen inside of these are very difficult to get out of. Once you're locked in inside of it, I've seen surrender periods as long as 15 years. Spoke with a client that was moving out of a CD and he got into a fixed index annuity. He thought it was a fantastic deal going into it before, but he was not informed. He wasn't educated on what fixed index annuities were doing. He was sold a product that necessarily he didn't want. So I asked him a few years, or basically a few months after he did it, I said, "How's it going?" He said, I don't understand it. I don't like it. I think I made a big mistake. So he wasn't informed in that decision to get into a fixed indexed annuity. So you got to be aware of your stipulations at maturity, what your cash value is going to be. Sometimes it can be very low compared to your expectations. So fixed index annuities are not for everyone. I don't really know who a fixed indexed annuity is for because they market to everyone. Everybody needs to be aware of that. They market to everybody. So you got to be fully understanding of what the fixed index annuity is for. It's for people that want the downside protection, but don't really care if you're capped on the upside. All right. So the very last explanation is a variable annuity. We all know someone who has either been sold a variable annuity or you've been sold a variable annuity. So the variable annuity is what we've all seen, very common. Your account balance will move up and down with whatever investment choices that you get into. These investment choices are typically mutual fund choices. The annuity company will manage those mutual funds, and they're called funds of funds, which means that they are sometimes more than not a direct copycat of a mutual fund. So the annuity will manage that mutual fund and they'll charge you an expense. So what I've seen with variable annuities is they're very expensive. Your fund choices can be limited. The advisors receive a commission, so once they get you to sign the paperwork, good luck ever contacting them again. Um, and you're locked in for 7 years or more. So I have on there too that some annuities, RMDs, which are required minimum distributions, RMDs are not friendly inside of some annuities. Most of them are. I haven't really come across any that aren't, but I've heard a lot of client experiences that they were either penalized or a lot of other weird stuff was going on in their annuity when they took the RMD. And really, the last part is clients really have no idea how to read their statements. So I've ran into salesmen that don't know how to read the statements either. So the client has to call the annuity provider and ask them questions that they may not understand. So the variable annuity, basically, you're buying you're buying insurance on the investment. So you're wanting that investment to grow. And before we kind of continue to move forward, is annuities are not a short-term insurance policy, and I go over it in the next slide. But everybody needs to understand when you get into annuity, you're buying it for the long term. So that's what everybody needs to understand. You buy an annuity, you got to hold it. So unless you just really want to get out of it. So next slide. It says, what's the purpose of an annuity? Who are annuities meant for? Well, annuities are meant for individuals that have strict income needs later in life. These can be individuals that retired too early. Maybe they have situations in their life that require a certain amount of income and they can't take a chance possibly going into the stock market or the equities market or even bond market. So these are going to be situations where strict income needs are held very precious to them. Maybe they want to buy protection from an insurance product. So that's what annuities are. They're insurance products. So maybe clients need some insurance protection. And then the last one that I've had a lot of experience with is the client that wants something that pays more than the CD rate. So these are really, really conservative clients that come in and want to deal with you, but possibly might not want to take a lot of risk. So I've had clients come in and they want to get something that pays more than a CD rate, so they'll get inside of an annuity. So we kind of talked about it before, but annuities, the way that an annuity is sold to clients, because I've had a lot of dealing with clients inside of buying annuities, their understanding of an annuity is that they are purchasing a short-term insurance policy on the investment. And let's say they buy it and hold it for 5 years and they think, okay, once the 5 years is up, I can take my money plus whatever insurance or guaranteed rate is on that amount, and that's what I get. That's not how it's sold. That's not how it should be understood. You do not get the guaranteed rate unless you keep the annuity to annuitization, which is the lifetime of you. Or you don't get it, but or unless you die, unless you pass away, your beneficiaries will get the death benefit on that side. So that's what you're buying inside of an annuity. So I have that part right there that says good for the seller. That's the whole thing, is it depends on how it's sold to you. If it's sold to you like an investment, a short-term investment, it's fantastic for the seller. If it's sold to you like an insurance product and like an annuity insurance product, like it should be sold, then it should somewhat mix and go into balance with your situation. So that's how it should be sold, but they're not. You got to understand there's people out there fighting hard for their jobs. They're going to try to sell commission on everything. So you got to be aware of the situation and what investments truly are. So what I've seen too in talking with clients that have purchased it is they always mention the guaranteed word. And we call it the G word because we can't put anything in our literature that says guaranteed. Annuities can because they're an insurance product. So just understand that too. If you see anything with guaranteed or anything on that side, it's an insurance product. It's not an investment, because investments that are regulated by the SEC and even FINRA on that side, you can't put guaranteed in any investment prospectus or anything else. So annuities are not guaranteed either because they're not protected by the FDIC rate. They're not. So in my time of dealing with them, I've been able to analyze what are they guaranteeing. Well, the annuity company is typically guaranteeing, and it's kind of a handshake type of guarantee, that they're going to pay your income and they're never going to run out of money, and they're going to continue to keep the company operating. So what they're ultimately doing is pinning the future of that financial strength on that annuity provider. And the reason why that comes into my next example is I had a client who had an annuity. She bought it back in 2008 when the market was going down. And this annuity provider was going to pay her 7% for the lifetime of the annuity. So I called the annuity company with her in my office. We double checked and they said, yep, we're going to pay her 7%. Doesn't matter what she does in the annuity, 7%. So I had that understanding of, this is a decent investment. Don't sell it. If it still goes by your objective and goals and what you want to do, don't get rid of it. Just continue to hold it. So I think about 3 or 4 months later, she received a letter from the annuity company saying, we want to buy out your contract. We'll give you 25% more on your cash value to go away. And I was kind of scratching my head at that point in time, not understanding what had gone on, because they just said a few months earlier that they were going to guarantee 7%. So I was kind of having lunch with a business partner, and we were both kind of understanding the situation, and immediately dawned on us that annuity companies, their bottom line is their ultimate objective. So they're going to have actuaries computing a lot of financial situations that's going on inside of the company. And the biggest thing for them to understand in that point was, how long are we going to have to keep this client, or how many products have we sold that are similar to this? Are they going to put us in the black? Are they going to put us in are they going to put us in the red? Are they going to make us profitable? And they became to figure out that these products that they were selling were ultimately not good for the annuity provider, and they had to do something with it, and this was their option. Give them upsell on their cash, let them walk away. So again, there's no guarantees. There are absolutely no guarantees with your products. So before we go into the next slide, there's going to be a poll that's going to pop up. So I'd like, just to kind of think about it a little bit, but basically the question is, how many negative markets do you think we've had in the last 20 years? So I'm going to turn my mic off, so you're not going to hear me continuing talking, kind of think a little bit. So I'm going to turn my mic off and let you answer. All right, and it's pretty much, we're split 50-50. We've got about half of you saying 5 years. We've got a half of you saying 15 or more. We'll go into the answer here in a little bit, but I just wanted to kind of everybody think about how many negative markets, and I'll be able to correlate and let that make sense here in a minute. So really the biggest thing in the last 10 years, the rise of the annuities. Why have annuities risen in the last 10 years? And the biggest thing is what are you sold on? You're sold on volatility. So depending on whatever TV station you're watching, news articles you're reading, whatever else, we are attracted to what entices us most to make decisions. And volatility is really big on our radar. So 2008, volatile time of the market, $265 billion in annuities were sold to clients at that point in time. So imagine being a annuity salesman in 2008. You probably did really well. I've known a few advisors that was their main business in 2008. Even though they were managing money for clients, they sold more in annuities in that year than they managed money. So in that point in time, volatility was big. 2011, again, that was kind of a flat market. That was the credit crunch. Banks weren't lending money. Probably a lot of people on that side were panicking because they were thinking, 2008's not over. Here it comes again. So again, annuity sales were decent at that point at that point in time, about 238 billion. And then 2015. So 2015, we were dealing with Draghi and the European Union making really confusing speeches that not a whole lot of people could analyze and truly figure out what they were going to do. So again, that was a kind of a flat market, and it was really confusing for money managers to manage money in that point in time. So again, rise of the annuities. Here they come. 2015, 236 billion were sold, and that's not even counting how much money is directly tied into annuities. So again, I reiterate this point that clients that I've spoken with and clients that I've sat across the table with, they've thought that annuities are just like a regular brokerage account, but there's a guaranteed on my market value. They're not. That's not how annuities function. That's how they're sold. But I want everybody to understand that's not how they function. That's not how they truly are. So that's just really not true. So I want you to be truly informed that annuities are not that way. So, all right, here's the answer. So volatility in the last 20 years, we've had 7 negative markets in the last 20 years. So again, annuities are sold heavily on volatility. So I've sat across the table from an annuity salesman, and I have asked him the same question: how many negative markets do you think we've had? And he was pretty much telling me, I think we've had about 10 or 12. And this is from an annuity salesman. He should understand the market a little bit. And that was kind of way off. So you got to kind of understand the type of person you're dealing with. Is these individuals should truly understand their products, and they're going to believe what everyone else is probably either thinking or telling them. But we've had 7 negative markets. That's considering 2008. So what I did as well is, yeah, we've had 7 in negative markets. So that means we've had 13 positive markets. So what type of return would that have been if you invested in the S&P 20 years ago? And it's about 6.47. So if you invested $100,000 in that point in time and you held it in the market, didn't make any movements, just kept it in the S&P 500, you would have $350,000, 350, 384 and 66 cents. So that's how much you would have. So again, I look at that and I say, that's not bad. That's really not a bad return for taking on some risk and leaving this money truly invested. Again, it depends on your situation. It depends on when you're possibly going to need to take withdrawals or distributions. This doesn't account for that. I understand that. But again, we kind of look at the overall, are you willing to take the risk? Annuities are not going to perform that way because we'll go over that here in a little bit. But are you willing to take the risk? Are you willing to tie it in longevity? And that's the whole part of investing. Is the longevity, are you willing to leave it there? So kind of brings us on to kind of the next topic, is really talking about the service from your annuity rep. So I've dealt with a lot of annuity reps, and honestly, they don't stay necessarily at the same company, because you have to understand, again, commission heavy business means sometimes people aren't going to meet their numbers, and there's a lot of people that are let go. There's a lot of companies that have gone under. So you have to understand that, sometimes the revolving door is going to be pretty constant. So, I usually ask this question to clients is, how long has it been since you've talked to this annuity provider? And they'll bring in a statement and say, I have no idea who this gal or guy is on my annuity statement. They didn't sell me the annuity statement. It's just somebody, over here in Yorba Linda. I have no idea who they are. It's just they haven't called me or anything. I don't know who they are. So your service from the annuity rep, they don't have to call you. They really don't have to call you. They can provide a statement to you every year, every quarter, and it tells you the value. But you just got to understand, annuities are really not investments; they're insurance products. So they roll by a different set of rules, and they can package themselves up differently. So what I have there written in script, and I doubt a lot of you can really understand it, but it says, "Can you understand your annuity statements?" So, can you understand your statements? Most of you might have a lot of questions pertaining to your statements. What does this value mean? What does that value mean? My annuity guy never went over my statements, so I don't understand what they are. So you're going to have questions. So what do you do? Who do you call? I've had clients come in and ask me, am I asking the right questions? Because I don't understand anything. This representative is on the other line. They're telling me industry jargon. I don't know what to do. And I've jumped on the line with clients before and I've asked the questions to them. I've made sense of the statement and we were able to understand everything like that. So throughout that point in time too, what I've tried to tell clients and continually educate a lot of individuals, even families, is the service from your financials should be the main feature sold to you during any involvement in your investments or in your financial life or tax life. The service is what you should be provided and sold on. It's not the products, because products get old, they get outdated. I'm going to tell you something right now, the fee compression that's going on in this industry, it's going to get old and outdated. Your service is going to drop. I don't really want to be calling into an AI robot system with my investments, and I can tell you that's probably where it's going. So service should be the main source of why you purchase whatever investment is. It should be the proper service for your situation. Um, so that should be the main focus in everything. The next uh, annuity slide that we're going to go through is going to talk about the explanation of a variable annuity. The reason why I have put this together is variable annuities are extremely hard to understand for the average client. You don't understand where your money's going. You don't understand what your money is doing. So the best way for me to categorize and talk about how annuities function is, let's look at it this way. So you walk into an office, you sign the paperwork, you have $100,000 to invest in an annuity. So basically the annuity company takes your money and whatever riders that you're purchased are put on the guaranteed side, and all of your cash value and investments are put on the other bucket over there on the right side, I guess you can say. I'm trying to think of it from my standpoint. Guaranteed on the left, cash market on the right. So the guaranteed value is locked away, it's insured. That's where you get the living benefit, typically sometimes what it's called. It's called guaranteed minimum income benefit. That's going to grow at whatever rider that you signed up for and you pay for, by the way. It can be 4%, it can be 3, 4, 5, whatever percent for that amount to grow. So you're also going to have, typically in variable annuities, a death benefit. And the death benefit will sometimes grow at the same amount, if not lower, if not higher. Typically, it's going to be at the same inside of that amount. So you may have a death benefit that grows at 4% as well. So that side, you cannot touch it. It's the reason why I have it in the lockbox. You don't know the combination to get it out. The annuity company knows the combination to get it out. Anytime that you take money from your portfolio, your guaranteed value is going to drop as well by whatever amount that you took out. So the only time that you get the guaranteed value, like I said before, is if you pass away and your beneficiaries get the death benefit, or if you annuitize the product and they give you monthly income on whatever the guaranteed amount is. So what is the cash market surrender value? The cash market surrender value, you're going to have that $100,000 in there. Market volatility is going to basically affect this bucket. Fees are going to be dragged out of this bucket. Cash distributions are going to be dragged out of this bucket, and fund expenses. So whatever funds you're inside of is going to be pulled out of this bucket. So this is completely dependent on the performance of your investments, mutual funds typically, or an index that you choose. So you need to see it like this right now. Is if you put your money into an annuity, you can't get the guaranteed side. So let's just blow that out. You can't get it. The only time that you get it is if you leave this world or if you annuitize, and you may not get the full value of that if you annuitize. So this is my little explanation. I hope it's somewhat been beneficial. Some clients have said, yes, that makes so much sense inside of understanding where my money goes. But if not, just always send me an email, give me a call. I can explain it a little bit further. Um, I've dealt with many clients coming in here and going through their statements. And the biggest focus is understanding what they have in front of them. Clients have been sold certain things and understanding, how do I do this? But before we kind of go into this statement, I've got another poll coming up, and I promise it's going to be the last one. But we want to talk about fees. I want to get everybody's understanding or everybody's opinion of how much do you think you pay in fees in your annuity. Again, I'm going to turn this mic off. I'm going to let you answer for a little bit. All right, everybody answered. Let's go ahead and look at that. We've got about half of it. Half of you are saying 2%, the other half are saying 3. You're pretty much somewhat close to it, but surprisingly, it's going to be 3 or 4% inside of a variable annuity. If you buy all the bells and whistles, it's going to be about 3 or 4%. And do not be fooled. Nowadays, they are able to categorize the fee-only variable annuity, but again, there's stipulations to it. There's back-end deals. Um, Similar to getting into a mutual fund. If you don't know the internal expense ratio of that mutual fund, you're not going to know the true cost of that investment. So just be fully aware that annuities are expensive for a reason. You're buying insurance on it. Okay, so let's get started in this variable annuity statement. This is a real statement from a client. She came over to us a few years ago, but she brought this over eventually whenever it matured. And she bought it back in 2007. So let's kind of go over what we have inside of the statement. So at the top, it says your account activity summary has the beginning account value, and then it has everything else. It has the quarter, year to date, since purchase. I have since purchase highlighted in yellow. The reason why is I want everybody to focus when she bought it. She bought it in 2007. She contributed $75,194.26. If you scan down to the left, just a little bit below that, it has requested withdrawals, 0. So she took no money out during that point in time. So throughout all those years of being invested, her net options of performance, that's on the quarter basis. I don't really care about that because the investment truly lost money. So her current total value at that point in time, 12/31/2016, was $74,000. I'm sorry, $74,906.58. She was really confused at what she bought because really she got into it 2007. The market should have grown a little bit. So what in the heck went on with this investment? So I kind of looked at it a little bit further, and what amounts you see below that says your optional benefit values, that's the insured, that's the guaranteed side. So again, you don't touch that side. You don't touch it at all. So you kind of have the roll up benefit basis, which is the guaranteed minimum withdrawal or account balance. So that's 131,363 and 69 cents. So that was growing at a guaranteed amount. And then you have the death benefit that's on there. So you see it's the exact same amount. So it'd have the exact same roll up on it. So at the very bottom, I have the cash surrender value. So she's been in this since 2007. And a company has the audacity to tell her, you've been in here since 2007. We're going to give you $73,000 to walk away. She was very upset with this policy. Didn't understand it. So being miffed by the whole situation too, I did some simple math. I took her guaranteed benefit base of 131 and I subtracted it by her cash surrender, which was about 73,000. And what I came out with was 57,426. Now, what does that number mean? What that number means is that is how much the annuity company took from her to guarantee 131 363. So that equates to a 4.4% a year rate or fee to guarantee the same amount of death benefit and income. And that amount never shows up on your annuity statements. You never understand what you're paying unless you do a fully engrossed uh, understanding of what's going on with your annuity. So being a little bit confused because I know what kind of client she is. I know she's very educated on what to invest in. I said, let me see your investments that were in this account. And her father told her a long time ago, diversification, you put some in large cap, you put some in small cap. You want to have about an 80-20 mix or a little bit less. And she did and operated by that same principle. So I was thinking, why did you lose money? So we went over what an 80-20 mix would have generated. And I kind of told her the S&P 500 and since 2008 generated a 7.4% return. So why have you lost money? Here's why she lost money. Fund expenses. Big time fund expenses. So you go through this account, you see that she had about 9 different funds inside of this account. Again, it's not her fault for wanting to be a diversified investor, but don't you think that annuity salesman or saleswoman should have told her, "Hey, just put it in one fund. You're already buying the insurance for this amount. Let that cash value grow, put it in large cap growth and leave it alone." Because why would it make sense if you're paying on the insurance for it to grow? Why would you diversify your investments on that side? You're not buying an annuity for its amazing investment performance. You're buying it for the protection for the insurance. So why wasn't that salesman telling her, hey, don't diversify it, just put it in large cap growth and leave it alone? Why wasn't he or she? Well, because it doesn't matter to him. He's getting his commission on this product, and it makes him look like a rock star whenever the annuity company sees that they were able to yank out 4.4% a year from her account. So again, it really, if you can hear the frustration in my voice, this is why I get frustrated. This is why I do what I do, and I have passion to help clients out. Is I realize that there's a lot of situations where clients are taken advantage of, and that was one of them. That's it would just frustrate anybody if you got in that investment. So she wanted to know too, hey, what would happen if I came over to Lighthouse in 2007 and invested with your portfolio or strategy? So I put her in our asset allocation strategy, which is ETF mix, very low cost. We would have doubled her money. That's net of fees, net of expenses. What type of interest rate or what type of return would she have had? A 6.9% return during that point in time. We would have doubled her money. And one thing too that I said is you could have had access to the team, and we could have assisted you with many more situations that are going on with your life. And she was going on with situations in her life. She needed help with a trust. She needed help with a financial plan. She needed help with taxes. She needed help with everything else. We could have assisted her in that point in time, and you just think of the possibilities and the better of a situation she could have been in if this annuity salesman wouldn't have gotten a hold of her. That's the bad thing. That truly is an unfortunate situation. So throughout the time of me looking at annuities, I see what illustrations they send clients. I see all the pretty paperwork they do to basically entice you to do an annuity. And this is a recreation of what they'll basically send you. So let's say you had $100,000, and again, this is the left and right secured box, cash value box. Secured box over here, it's growing at 4% a year, so it shows you the amount going up every single year since 2000 or since 2008 to 2018. And then on the right side, that's if this investment was in an asset allocation mix minus fees, and then you got to add in performance. So that would have been the balance on that side. So if you decide to walk away in 2019, which is basically what we've had at that point in time, you would have the cash value of about 117,000. So This is why this is why annuities are not short-term investments. You kind of understand the situation in this time is you pay a lot in fees. If you pay a lot in fees in this investment, this is not a short-term investment. This is something you have thought about. This is something you are going to hold in there until you leave this world. So this is why I educate clients on annuities. Is this is what situations you're running into. So so also I've had clients in that stage where they have needed to annuitize the product. And they've asked me questions of, well, what happens when I annuitize? What happens with your policy when you annuitize is you give 100% control to that annuity company. So they take all of your money, all of your investments in that point in time, and they get them out of equities and they put it into a fixed income or bond portfolio. So your account now has to survive the annuity company's viability and the bond market. So the company at that point in time will calculate your annual withdrawal amount and what you get. So if your example is say $100,000 and guaranteed lifetime value at 65, they'll pay you out about 580 a month or 6,900 a year. So you have to understand actuaries, not only do they work in regular insurance and anything else, they work in annuities. So they're there to calculate viability for whatever this person, if they're a smoker, if they have heart problems, cancer, everything else, that's what an annuity is going to calculate you on. So they'll pay you out a check, maybe monthly, quarterly, annually, whatever you want to be inside of until the principal is depleted and you pass away. So the biggest issue for me on this side is, what if the bond market underperforms? Is that annuity company going to pay if the bond market underperforms? You're stuck. You're stuck in that investment. Can your money last as long as you? And that's what we always want, is our money lasting longer than us. So the last if one well we've got a few more slides from here, but the next slide we're going to go into is, what do I do with my annuity? So I'm in this stage, I don't know what to do with my annuity. What can I do? You have a few choices. You can walk away. So you can surrender your annuity and you can take the cash. Now, be fully aware, if it's not a qualified account, or even if it's a qualified account, if it's money that you take out, you have to understand that annuities are taxed as income on the earnings after or higher than the original investment. So if you put $100,000 in and the annuity makes 150, you're going to be on the line for $50,000 in income for that year. So be fully aware of that. The next option, you can annuitize. We talked about that. It can be beneficial for some. It's not beneficial for everybody. And then the last option is you can transfer. So you can either transfer to another annuity company or you can transfer to an investment account. So I'm just going to go over some quick tax situations. So if you go from an IRA annuity to an IRA brokerage account, that's okay. There's no taxes. If you go from an IRA annuity to another IRA annuity with a different company, no taxes. It's okay. It's still staying in the vehicle. The last situation where it's okay, no tax, is if you go from an individual joint annuity to an individual joint annuity. So you're going from one annuity company to the other. It's called a 1035 exchange. Again, that's okay. It's no tax. You're not going to get hit for it. Where taxes come into play is when you go from an annuity to a brokerage account, if it's an individual or joint investment. If it's an IRA, like what we talked about before, where it's IRA annuity to IRA brokerage, it stays in the IRA vehicle, so you're not taxed. But if it's in the individual or joint package and you're moving from annuity to brokerage account, you're going to get hit on taxes. They're gonna hit you on income tax above the original investment. So um, now, how can Lighthouse help you? And that's something that we've really focused on, is helping clients and how we can help situations for clients in the future. Well, the very first thing is we're client centered. So I've mentioned to you before that we help a lot of our clients in whatever situations. It's like a partnership. So it's a partnership, but we do all the heavy lifting. So it's a full service deal of coming over and dealing with Lighthouse. So we're going to help you with any and everything that we can. The next focus that I always put it there is no commissions. We're salaried employees. I don't get paid a commission to have a client come on board. We're happy to have clients come on board, and we're happy to have new clients, but it doesn't affect my pay. I don't get a commission for bringing on new people. That's not the objective of helping people with their finances. And the last thing is we're service oriented. So again, we don't sell products. We sell our services. We sell our excuse me. We sell our full service services. So it's financial planning, tax planning, investment management. So we've helped clients in your situations get out of annuities or get out of other investments. We can help you do it. And we can do it at the most educated basis so that you can understand exactly what's going into or what you're getting yourself into. Is we give you a full look and an honest look of how much you're going to pay, what services are provided. We have to provide everything like that to you. The worst thing is that I can see is clients get taken advantage of, and I've seen a fair share of clients get taken advantage of. All right, hold on. Let me read this real quick, Jim, before we. So you have an IRA annuity. We'll be transferring the annuitization value or the cash value. You would be transferring the cash value, so it'll have the surrender value. It's typically going to be lower. The annuitization value is going to be higher because it has that guaranteed rate attached to it. So you'll have two values. You'll get the surrender value, basically, is what you get if you leave that account. So if you came over and did something um, inside of a brokerage account, you would get the surrender amount. So, okay, so I offer this for a lot of clients, but what's your next move? Is I'm here to help. I think we've thrown a few offers out there today about a free 15-minute call with myself to see if I can help you in this situation. So please don't be bashful or shy about setting up an appointment. We'll always set up an appointment for you, and if it's anything that we can help, we would really enjoy to do that. So I'm going to leave the chat box open a little bit so that individuals and just whoever else jumped on can ask questions if they need to. But thank you again for spending your time with me today. I really value your time. It's the greatest asset that we all have. I hope it was extremely valuable for you. But if you need anything else, please let me know. And I hope I've helped a lot of you expose either an annuity that you have or maybe one in the future that you might be sold. So again, have a great day and let me know if I can help you. Take care, guys.